For a moment, forget politics. Forget left versus right. Forget headlines, elections, and culture wars. I want you to sit with a single number, $317 trillion. That is the total global debt. Governments, corporations, households, all combined. Now here's the part that should stop you cold. $317 trillion is more than 3 times the total economic output of the entire planet. Every factory, every farm, every software company, every hospital, every worker on Earth, all of it multiplied by 3. And it still wouldn't be enough to pay what is owed. So here's the question no one asks. If everyone owes money, who exactly is the lender? Because debt is not abstract. For every borrower, there must be a creditor. For every obligation, someone holds a claim. And when you follow that question all the way to the end, not emotionally, not politically, but mathematically, you discover something deeply unsettling. This isn't a crisis, it's not an accident, and it's not mismanagement. It's a system, and once you see it clearly, you can't unsee it. Let's start with something simple. When most people hear the word debt, they think in personal terms. You borrow $10,000 from a bank. The bank gives you $10,000. You pay it back, plus interest. That feels intuitive. It feels fair. It feels grounded in reality. But that is not how modern debt works at the scale that actually matters. Because when governments borrow money, especially the United States, the money is not transferred from a vault somewhere. It is created. When the U.S. Treasury issues bonds, those bonds are purchased by banks, funds, and central banks. And in the process of that purchase, new money is brought into existence. This is not a theory. This is not speculation. This is how the system is designed. The Federal Reserve does not have money in the way households do. It creates reserves digitally, expanding its balance sheet. Assets on one side, liabilities on the other. And when commercial banks participate, they do something similar through fractional reserve lending. The key insight, the one almost no one explains clearly, is this. The principle is created. The interest is not. If $1 trillion is borrowed at 5% interest, $1 trillion enters the economy. But the obligation is $1 trillion plus 50 billion. That extra 50 billion does not exist. It must be pulled from future borrowing, future growth, or future debt. Which means the system does not merely allow debt to grow. It requires it. This is not a moral judgment. It is a mathematical one. Total debt must always exceed total money. And that single fact explains almost everything that follows. Now zoom out. Globally, debt stands at roughly 330% of world GDP. In the United States, federal debt alone exceeds 120% of GDP, a level once associated with wartime emergencies. Corporations are leveraged, households are leveraged, governments are leveraged, and yet markets remain calm. Interest payments are made, bonds are bought. Confidence persists. Why? Because the system has one unspoken assumption baked into it, that growth will always continue, that tomorrow's economy will be larger than today's, that future productivity will pay for present obligations, that expansion will outrun compounding interest. But here's the problem. Growth is slowing. Demographics are aging. Productivity gains are flattening. Energy returns are diminishing, and real GDP growth in developed economies struggles to exceed 2 or 3%. Meanwhile, debt compounds at 5%, at 6%, at 7%. Debt grows exponentially. The real economy grows linearly. These two curves cannot coexist forever, and yet they are treated as if they can. So again, we return to the core question. If the world owes $317 trillion, who owns the assets on the other side? The answer is not everyone. Ownership is not evenly distributed. In fact, it is concentrated at a scale unprecedented in human history. Let's break it down carefully. The first major category of creditors is central banks, the Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, the Bank of England. Together, central banks hold tens of trillions of dollars in government debt. In Japan, the central bank owns more than half of all government bonds. In the United States, the Federal Reserve holds trillions in treasuries and mortgage-backed securities. These institutions are often described as public, but their structure is more complex than most people realize. The Federal Reserve, for example, is not a typical government agency. It is a hybrid system created by Congress but owned by member banks. Its regional banks distribute earnings to private institutions. Its policy decisions directly shape asset prices across the economy. This structure did not emerge accidentally. The Bank of England, founded in 1694, was created as a private institution to finance government war debt. In exchange, it received monopoly privileges over currency issuance. From the very beginning of modern finance, sovereign debt and private banking were intertwined. That legacy never disappeared. It evolved. The second major category of creditors is institutional investors. Pension funds, insurance companies, mutual funds, asset managers. Collectively, these entities control well over $100 trillion in financial assets. They are often framed as representing ordinary people, teachers, firefighters, retirees. And in theory, that is partially true. But control is not the same as ownership. Decision-making power resides with fund managers. Voting power concentrates in a small number of firms, and the largest asset managers, names like BlackRock, Vanguard, and State Street, hold significant stakes in nearly every major corporation. This creates a feedback loop. Debt finances corporations. Corporations generate profits. Profits flow into funds. Funds purchase more debt. The system reinforces itself. The third category is foreign governments. Countries like China, Japan, and oil-exporting nations hold trillions in U.S. treasuries. This is often framed as a vulnerability, as if America is indebted to China. But that framing misses the deeper dynamic. These holdings are the result of trade imbalances. When the United States runs persistent trade deficits, dollars accumulate overseas. Those dollars must go somewhere. U.S. government debt becomes the default parking place. This arrangement benefits both sides. Until it doesn't. It locks exporting nations into dollar dependency, and it locks the U.S. into perpetual borrowing. Finally, there is the smallest group numerically, but the largest in influence. High net worth individuals, family offices, dynastic wealth. The top 1% owns a disproportionate share of global financial assets. The top 1% owns an even larger share. These are not people living paycheck to paycheck. These are entities that live off interest, dividends, and capital gains. When you reach this level of wealth, preservation becomes the goal. And the safest assets in the world are government bonds. This is where the system quietly reveals its true function. Debt is not merely a tool for funding growth. It is a mechanism for transferring wealth upward. Interest flows from borrowers to lenders, from workers to asset holders, from taxpayers to bondholders. And because interest compounds, the transfer accelerates over time. This is not because of greed, it is because of structure. The system does exactly what it is designed to do. And here's the crucial insight. Even if nothing goes wrong, even if there is no crash, even if markets remain calm, the math still breaks. Because debt grows faster than the economy that services it, which means the question is not if the system changes, it is how. And who pays the price when it does? That's where this story actually begins. Now we need to confront a difficult idea. If this system is mathematically unstable, why hasn't it collapsed already? Why hasn't the global debt structure imploded under its own weight? Why do markets still function, governments still borrow, and everyday life still move forward? The answer is subtle and unsettling. The system survives not because it is sustainable, but because it is adaptive. It does not resolve its contradictions, it postpones them, and the way it postpones them reveals who truly benefits. Let's talk about interest. Interest is often described as the price of money, but that definition hides its real function. Interest is a claim on future production. When a government issues debt, it is not promising to repay money that already exists. It is promising that future taxpayers will produce enough value to honor that obligation. This means debt is fundamentally a political promise disguised as a financial instrument. And the longer the time horizon, the easier it is to make that promise. 30-year bonds, 50-year bonds, perpetual debt. The burden is pushed forward, beyond electoral cycles, beyond current voters, beyond public attention. This is why debt rarely feels urgent, until it suddenly is. Historically, societies have dealt with excessive debt in only a few ways: default, inflation, restructuring, or some form of debt forgiveness. Every empire that relied heavily on credit eventually faced this reckoning. Ancient Rome debased its currency. Medieval kingdoms periodically canceled debts. Modern states inflate. The mechanism changes. The outcome does not. So let's examine the most common modern solution: inflation. Inflation is often described as rising prices. But that's a symptom, not the cause. At its core, inflation is the reduction of purchasing power of money. And from the perspective of debt, inflation is extraordinarily useful. If you owe $1 trillion and the value of money declines by 10%, you've effectively reduced your real debt burden without defaulting. This is why heavily indebted governments tolerate inflation and often quietly rely on it. But inflation is not neutral. It does not affect everyone equally. Those who hold cash lose. Those who hold bonds lose. Those who live on fixed incomes lose. Those who hold real assets, land, stocks, businesses, are protected. And those who can borrow cheaply to acquire those assets often benefit. This creates a powerful asymmetry. The same system that expands debt also inflates asset prices. Stocks rise. Real estate rises. Financial assets outperform wages. Over time, wealth concentrates, not because of individual failure, but because of systemic design. This is why inequality widens during periods of monetary expansion, and why financial crises often accelerate concentration rather than reverse it. Now let's talk about something rarely discussed openly. Who decides when and how money is created? Central banks are often portrayed as neutral technocratic institutions, independent, objective, data-driven. But independence does not mean absence of influence. Central banks respond to markets. They stabilize asset prices. They intervene when financial plumbing breaks. And when they do, they overwhelmingly act to protect the system's core. In 2008, trillions of dollars were created to stabilize banks and financial institutions. In 2020, trillions more were created to prevent systemic collapse. These interventions were framed as emergency measures, and perhaps they were. But emergencies have a way of becoming precedents. Each crisis expands the boundary of acceptable intervention. Each rescue reinforces expectations, and each cycle deepens dependence. This is the paradox. The more debt accumulates, the more fragile the system becomes. And the more fragile it becomes, the more aggressively it must be protected, which means more intervention, more liquidity, more debt. This is not corruption, It is momentum. Now let's examine the role of the United States more closely. The US dollar is not just a national currency. It is the world's primary reserve asset. Oil is priced in dollars. Global trade settles in dollars. International debt is denominated in dollars. This gives the United States extraordinary privileges. It can borrow in its own currency. It can run persistent deficits. It can export inflation. But it also creates global dependencies. When the Federal Reserve raises interest rates, the entire world feels it. Capital flows shift. Emerging markets strain. Debt servicing costs rise. The decisions of a small group of policymakers ripple across continents. This is not a conspiracy. It is the consequence of scale. And it places the United States at the center of the global debt system, whether Americans realize it or not. Now here's where the narrative becomes uncomfortable. Because when people talk about debt, they often frame it as irresponsibility, overspending, waste, political dysfunction. But that framing misses the deeper truth. Debt is not the result of moral failure. It is the fuel of the modern economy. Without debt, housing markets collapse. Without debt, corporations shrink. Without debt, governments lose flexibility. Debt enables growth until it doesn't. And the transition point is never obvious in advance. This is why the system feels stable right up until the moment it isn't. But there's another layer to this story, one that rarely makes headlines. Debt is not just financial. It is psychological. When people carry debt, their behavior changes. They become risk-averse. They prioritize stability over innovation. They accept conditions they otherwise wouldn't. This is true for individuals, and it is true for nations. A heavily indebted society becomes cautious, dependent, easily managed. Debt disciplines behavior. And in that sense, it is not merely an economic tool. It is a governance mechanism. Now consider this. If total global debt cannot be repaid, and mathematically it cannot, then repayment is not the objective. Servicing is. As long as interest payments continue, the system functions. As long as cash flows upward, balance sheets remain intact. The goal is not resolution, it is continuity. This reframes everything. Crises are not anomalies, they are pressure valves. They reset valuations, they clear weak participants, they consolidate ownership. After every major financial crisis, fewer entities control more assets. Banks merge, funds grow, households lose. This pattern is not hidden. It is observable, and it repeats with remarkable consistency. Which brings us to the most important question of all. What happens next? Because the current trajectory cannot continue indefinitely. Debt grows faster than GDP. Interest consumes a growing share of output. Demographics reduce the base of contributors. Something must give. And historically, there are only three paths forward: default, inflation, or restructuring. Default is politically catastrophic. Inflation is socially corrosive. Restructuring threatens entrenched interests. Every option carries pain. The question is not which option is painless. It's who absorbs the pain, and who is shielded from it. That decision is rarely democratic. It is negotiated quietly, through policy, markets, and institutions. And it tends to favor those with leverage, those with assets, those with access, those with influence. This is why understanding the debt system is not about economics. It's about power. Who holds claims, who writes rules, who sets terms, and who is left navigating the consequences. In the next part, we'll look directly at historical moments when debt systems reached their limits. What happened then? Who lost? Who emerged stronger? And why the patterns matter now more than ever. Because the numbers we're dealing with today are unlike anything the world has seen before, and the outcomes will shape the next generation. To understand where this system is heading, we need to look backward, not at opinions, not at ideology, but at history, because debt crises are not new. What's new is their scale. Every major civilization that built its economy on credit eventually faced the same question we face today. How do you deal with obligations that exceed your capacity to pay? Let's start with a moment most Americans vaguely know, but rarely connect to the present. The Great Depression. In the 1920s, the United States experienced an explosion of credit. Margin debt fueled the stock market. Easy lending expanded consumer purchases. Farmers borrowed heavily to mechanize production. Productivity rose. Asset prices soared. Confidence felt unbreakable, until it wasn't. When the system snapped in 1929, the problem wasn't just falling stock prices. It was debt. Households defaulted, banks collapsed, credit evaporated. And here's the crucial detail. Those who had leverage lost everything. Those who had liquidity bought everything. Banks that survived foreclosures acquired land. Investors with cash acquired businesses. Ownership consolidated. The crisis didn't destroy capital. It redistributed it. The same pattern repeated after World War II, but with a different approach. The Bretton Woods system created a new monetary order. Currencies were pegged to the dollar. The dollar was pegged to gold. Debt was constrained by reserves. For a while, the system worked. Growth was strong. Wages rose. Debt remained manageable. But discipline has a cost, and eventually, political pressure outweighed monetary restraint. In 1971, the United States ended dollar convertibility to gold. This moment, often called the Nixon shock, changed everything. Money was no longer tied to a physical limit. Debt could expand freely. And it did. Federal deficits grew. Household credit exploded. Financial markets deepened and globalized. This wasn't inherently malicious. It unlocked growth. It financed innovation. It expanded consumption. But it also removed the final constraint. From that point forward, debt growth became a policy tool. Recessions were met with lower interest rates. Crises were met with liquidity injections. Each intervention solved the immediate problem and amplified the long-term one. Fast forward to 2008. The global financial crisis is often blamed on subprime mortgages. But mortgages were only the spark. The real fuel was leverage. Banks were overextended. Derivatives magnified exposure. Confidence masked fragility. When the system seized, governments stepped in. Trillions were deployed, and once again, the pattern held. Losses were socialized, assets were preserved, institutions grew larger, households lost homes, banks gained scale. The system survived, but at a cost. Debt didn't disappear. It migrated, from private balance sheets to public ones. This is a crucial insight. Modern crises do not eliminate debt. They relocate it. And each relocation centralizes control. Now consider 2020. The pandemic triggered the largest monetary response in history. In a matter of months, trillions of dollars were created. Markets stabilized, asset prices soared, inequality widened. Once again, the system proved resilient. But resilience is not the same as health. What we are witnessing is not stability. It is postponement, and postponement has consequences. Let's talk about interest rates. For decades, interest rates trended downward. This made debt cheaper. It made borrowing attractive. It inflated asset values. But low rates are not a free lunch. They encourage leverage. They punish savers. They distort price signals. Eventually, inflation forces a response. Rates rise. And when they do, the weight of accumulated debt becomes visible. Governments face higher servicing costs. Corporations face refinancing risk. Households feel pressure. This is where the system reveals its constraints. You cannot normalize rates without destabilizing balance sheets. You cannot inflate forever without eroding trust. You cannot grow debt faster than the economy indefinitely. Something must adjust. Historically, when faced with this dilemma, societies choose the least politically visible option. They inflate. Inflation is subtle. It spreads pain. It obscures accountability. People blame prices, not policy. But inflation also reshapes behavior. It encourages speculation. It discourages saving. It rewards asset ownership. Once again, wealth concentrates. And once again, those closest to the source of money benefit first. This is known as the Cantillon effect. Those who receive new money early can buy assets before prices rise. Those who receive it later face higher costs. This is not theory, it is observable reality. Now let's zoom out. Global debt has reached a point where even modest interest rate increases create strain. This is why central banks hesitate. They are trapped between inflation and insolvency. Raise rates too much and the system breaks. Hold rates too low and inflation persists. This is not incompetence, it is constraint. The system has painted itself into a corner. Which brings us to the most controversial concept of all. Debt jubilees. Throughout history, societies periodically wiped debts. Ancient Mesopotamia did this regularly. Medieval Europe did it selectively. Post-war Germany effectively did it through restructuring. Debt jubilees are not moral gestures, they are systemic resets. But in modern financial systems, jubilees threaten asset holders. They disrupt balance sheets, they undermine confidence, they challenge power structures. So they are rarely discussed. Instead, debt is rolled over, extended, refinanced, monetized. The illusion of continuity is preserved, until it can't be. Now here's the part most people miss. The system does not require collapse to function, it only requires compliance. As long as people work, borrow, consume, and service debt, the machine runs. Collapse is only a risk when confidence breaks, and confidence is psychological. This is why narratives matter, why debt is framed as manageable, why growth is emphasized, why crises are described as temporary. The goal is not to lie, it is to maintain belief. Because belief is the true foundation of modern finance, and belief can persist far longer than fundamentals. But belief is not infinite. When it breaks suddenly. And when it does, the outcomes are not evenly distributed. Those with optionality survive. Those without it suffer. This brings us to the present moment. Debt levels are higher than ever. Monetary tools are exhausted. Political polarization limits coordination. The margin for error is thin. And yet, daily life continues. Markets open, bills are paid, work gets done. This is how systems endure, until they don't. The question is not whether history will repeat. It always does. The question is how, and who is prepared. In the final part, we'll bring everything together. What this means for individuals, what it means for societies, and what intelligent awareness looks like in a system built on debt. Because understanding the system doesn't mean escaping it. It means navigating it consciously. So where does this leave us? After all the numbers, all the history, all the structure, what does a $317 trillion debt system actually mean for real people? For families, workers, entrepreneurs, and citizens? because if this conversation stays abstract, it misses the point. Debt is not just something governments carry. It shapes everyday life. It determines what kind of jobs exist, what kind of risks people can take, what kind of future feels possible. Let's bring this down to the human level. When debt becomes the foundation of an economy, stability replaces creativity. People choose safer paths. Corporations prioritize short-term cash flow. Governments manage perception instead of solving root problems. This is not because individuals lack ambition. It's because leverage limits freedom. A society saturated with debt becomes cautious by design. Now think about what this does over generations. Young people start adult life already behind. Student loans delay families. Mortgages lock people into decades-long obligations. Healthcare debt turns illness into financial trauma. None of this is accidental. Debt shifts risk downward. Institutions are protected. Balance sheets are stabilized. Individuals absorb volatility. This is why the system appears to function smoothly at the top, while feeling increasingly fragile at the bottom. And yet, despite all of this, the system persists. Why? Because it offers just enough opportunity to maintain participation. Most people don't need the system to be fair. They need it to be survivable. As long as the majority can keep going, paying bills, servicing debt, maintaining hope, the structure holds. This is the quiet genius of the design. It does not rely on force. It relies on normalization. Debt becomes background noise, interest becomes invisible, and systemic extraction becomes routine. Now let's confront a difficult truth. There is no clean exit from this system. There is no moment where the world wakes up, agrees to reset everything, and starts fresh. That's not how power works. Change happens through stress, through imbalance, through moments when the old rules can no longer be enforced. And when that happens, those who are prepared don't panic. They adapt. Preparation does not mean predicting dates or chasing collapse narratives. It means understanding incentives, understanding structure, understanding that systems don't care about fairness. They care about continuity. So what does intelligent awareness look like inside a debt-based world? First, it means recognizing that money is not neutral. Where money flows tells you where power resides. When asset prices rise faster than wages, that's not random. When debt expands faster than GDP, that's not mismanagement. Those are signals. Second, it means understanding that stability is often an illusion created by intervention. Calm markets do not mean healthy fundamentals. They mean managed outcomes. Third, it means separating personal strategy from systemic fantasy. You don't need to believe the system will collapse tomorrow. You just need to understand that it will change. And change never distributes costs evenly. History is clear on this. Every major transition, inflationary, deflationary, or structural, protects assets before incomes. It protects institutions before individuals. It protects those with leverage before those without it. This is not pessimism. It's pattern recognition. Now let's talk about something important. Understanding this system is not about fear. It's about clarity. Fear paralyzes. Clarity empowers. When you see the structure clearly, you stop personalizing systemic outcomes. You stop blaming yourself for pressures that are structural. And you start asking better questions. Why is growth required for stability? Why is debt treated as inevitable? Why are alternatives dismissed as unrealistic? These questions don't make you radical. They make you literate. And literacy is the most dangerous thing to any opaque system. Because once people understand how something works, they stop confusing outcomes with intent. They stop being distracted by surface narratives. They start looking at incentives. And incentives reveal truth faster than ideology ever could. Now let's come back to the original question. If everyone owes money, who is the lender? The answer is not a single institution, not a secret room, not a hidden hand. It is a network, a structure, a system where claims accumulate upward through interest, ownership, and control. Where money is created through debt, where debt requires growth, where growth eventually hits limits, and where adjustment is inevitable. This system didn't appear overnight. It evolved. It solved real problems. It enabled extraordinary progress. But like all systems, it carries trade-offs. And those trade-offs compound. We are living inside the late stage of a model that prioritized expansion over resilience, efficiency over redundancy, leverage over margin of safety. That doesn't mean catastrophe is guaranteed, but it does mean complacency is dangerous. The future will not be defined by whether the system survives. It will be defined by how it adapts and who bears the cost of that adaptation. And this is where you come in, not as a savior, not as an outsider, but as a participant who chooses awareness over denial. If you've made it this far, it's because you don't want simplified answers. You want understanding. And that matters, because thoughtful people shape culture long before policy changes. Conversations change norms. Norms change incentives. Incentives change systems. This is slow, but it's real. So if this analysis helped you see the world a little more clearly, not cynically, not fearfully, but honestly, then there's something meaningful you can do. Not for the algorithm, not for virality, but for the conversation. If you believe this perspective deserves space, you can support it. A simple subscription tells platforms that long-form, serious thinking still matters. A like helps this reach people who are quietly asking the same questions you are. And if there's one person in your life, a friend, a sibling, a colleague, who enjoys deep conversations and doesn't settle for surface explanations, send this to them. Not to convince them, but to think together. And if you choose to leave a comment, don't rush it. Say something real, something reflective. Because behind this video is someone who spent time studying, synthesizing, and trying to make sense of a system that affects all of us. Thoughtful comments don't just support creators. They elevate the discussion for everyone. This isn't about fear. It's about awareness. And awareness is the first step toward agency, in any system, at any scale. Thank you for thinking deeply.